On January 20th, 2026, something happened in Tokyo that could cost you thousands of dollars this year. The world's second largest bond market just had its worst crash since 1999. Japan's 40-year bond yield hit 4% for the first time in history. Their 30-day yield had its largest single-day spike in 25 years. And within hours, US Treasury yields spiked too. Now, you might be thinking, why should I care what happens in Tokyo? Here's why. Japan holds $1.2 trillion of American debt. They're the single largest foreign buyer of US Treasuries, and if they start selling, your mortgage rate goes up, your 401k goes down, and the US government's interest payments, already over $1 trillion a year, spiral even higher. This isn't hypothetical. It's happening right now, and almost nobody is talking about it. To understand what just happened, we need to start with one woman, Sanae Takaichi, Japan's Prime Minister. On January 19th, she made two announcements that sent shockwaves through global markets. First, she called a snap election for February 8th. Second, she promised to suspend Japan's 8% consumption tax on food for 2 years. Now, that sounds great for Japanese voters, right? Lower taxes on food during a cost of living crisis? There's just one problem. Japan already owes almost 230% of its GDP in debt. That's the highest of any developed nation, higher than the US, higher than Italy, higher than Greece at the peak of its crisis. And now she's promising unfunded tax cuts to win an election? The bond market's response was immediate and brutal. On January 20th, Japan's 40-year bond yield shot above 4%, a level it had never reached since that maturity was created in 2007. The 30-year yield hit 3.8%, an all-time record, with its largest daily jump since 1999. The 10-year yield hit 2.34%, highest since 1999. In a single day, investors dumped Japanese government bonds like they were radioactive. And here's what you need to understand. This isn't just Japan's problem. Japan's bond market is $7 trillion. It's the second largest in the world. And for decades, Japanese money has flowed into American assets, our stocks, our bonds, our mortgages. When Japan's market breaks, the shockwaves hit your wallet. To understand why Japan's crisis affects you, you need to understand something called the yen carry trade. Don't worry, I'm going to make this simple. For the last 30 years, Japan has kept interest rates near zero, sometimes even negative. Meanwhile, the US has had rates of 4%, 5%, and sometimes higher. So what did smart money do? They borrowed money in Japan, where it was basically free, converted it to dollars, and invested it in American assets that paid 4 to 5% returns. Borrow at 0, earn at 5, pocket the difference. It was essentially free money. And I am not talking about small amounts here. Estimates put the yen carry trade at $500 billion to $1 trillion. Japanese investors hold $1.2 trillion in US Treasuries alone, plus hundreds of billions more in US stocks and mortgage-backed securities. This trade, this flow of money from Japan to America, helped keep US interest rates low for decades because it created demand. It helped fund our mortgages. It helped inflate our stock market. But now the trade is reversing. Japan's rates are rising. The Bank of Japan just hiked to 0.75%, the highest since 1995. Japanese bond yields are now competitive with US bonds. And the yen? It's collapsed 54% since 2020. If you're a Japanese investor, the math has changed. Why take the currency risk of investing in America when you can earn decent returns at home? So the money is starting to flow back. Japanese investors are selling US assets and bringing that money home. And just last week, Michael Burry, the guy who predicted the 2008 crash, warned about exactly this. He said the yen is long overdue for a trend reversal, and warned US investors about what would happen as funds are repatriated from the United States to Japan. When hundreds of billions of dollars start flowing out of US markets, everything reprices. Okay, so Japan has problems. The carry trade is unwinding. But how does this actually affect your life? Let me make it concrete. Japan is the #1 foreign holder of US Treasury bonds, $1.2 trillion worth. They also hold a massive chunk of US mortgage-backed securities. When Japan buys these bonds, it pushes yields down. That means lower mortgage rates for you. When Japan sells these bonds, or just stops buying, Yields go up, and so does your mortgage rate. The 30-year Treasury yield just hit 4.93%, inching toward that critical 5% level. Mortgage rates follow Treasury yields. If Japan accelerates its selling, we could see mortgage rates push toward 8% or higher. Remember, the Fed has been cutting rates, but mortgage rates haven't dropped much. Why? Partly because of what's happening in Japan. Global capital flows matter more than most people realize. Here's the bigger picture most people miss. The US government is already paying $1.2 trillion per year just in interest on our debt. That's more than we spend on defense, and that number is calculated at current interest rates. If Japan stops buying, or worse, starts selling, someone else has to buy all those treasuries, and they'll demand higher interest rates to do it. Higher rates mean higher interest payments. Higher interest payments mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means even higher rates. It's a doom loop, and Japan pulling back could be the trigger. Here's the kicker. Japan is trapped. They can't lower rates because inflation is running at 3%, above their target for 4 straight years. But they can't raise rates aggressively either, because their own debt payments would explode. So they're stuck. And when Japan is stuck, we feel it. Now some of you might be thinking, this sounds scary, but hasn't Japan always had high debt? Maybe this is overblown. Fair question. Let me show you why this time is different. In August of 2024, the Bank of Japan raised rates unexpectedly. The yen strengthened 14% against the dollar in weeks. The carry trade started unwinding. Result? The Nasdaq dropped 13%. The VIX, the fear index, spiked. There was synchronized selling across global markets. Tech stocks, the ones most bought with borrowed yen, got crushed. It was fast, it was violent, and it caught almost everyone off guard. Then the BOJ backed off. They signaled they wouldn't be aggressive. Markets stabilized. But here's the thing, that was a small rate hike. A surprise, yes, but a small one. What we're seeing now is different. Japanese yields are at their highest levels in 25 years, and instead of backing off, Japan's politicians are promising more spending. Remember Liz Truss, the UK Prime Minister who lasted 45 days? In September 2022, she proposed unfunded tax cuts. The bond market crashed, yields spiked, the pound collapsed. Pension funds nearly went insolvent. She was out of office in 6 weeks. The bond vigilantes, investors who punish governments for fiscal irresponsibility, destroyed her government. Now look at what PM Takaichi is doing. She's proposing unfunded tax cuts. Her bond market just crashed. Yields are spiking. The yen is at a 30-year low. She's doing exactly what Liz Truss did, except Japan's debt is 230% of GDP, more than double the UK's. If the bond vigilantes came for Truss, what do you think they'll do to Japan? And what happens to America when our biggest creditor is under attack? Let me give you 2 scenarios. Japan's election passes without major disruption. Takaichi either wins or moderates her spending plans or loses to someone more fiscally responsible. The Bank of Japan and Ministry of Finance jawbone the markets. Yields stabilize, the carry trade unwinds gradually, over years, not months. In this scenario, US Treasury yields rise slowly toward 5 to 5.5%. Mortgage rates stay in the 6 to 7% range. The stock market sees some volatility, but no crash. This is the base case, the market-friendly outcome, and it's still possible. The election creates more uncertainty. Takaichi doubles down on spending promises. Bond markets lose confidence. Japanese yields spike further. The carry trade unwinds rapidly, in weeks or months, not years. Japanese institutions start dumping US treasuries to shore up their own positions. In this scenario, US Treasury yields could spike towards 6% or higher. Mortgage rates could hit 8%. The stock market could see a 15 to 25% correction, and we might see bank solvency concerns, similar to what happened with Silicon Valley Bank in March of 2023. This is the tail risk. It's not the most likely outcome, but it's not impossible either. Here are the warning signs to watch. Japan's 10-year yield, currently around 2.2%. If it breaks above 2.5%, that's a warning sign. The yen, currently 157 to the dollar. If it breaks below 165, that's trouble. US 30-year Treasury, currently 4.93%. If it breaks above 5.5%, we're in dangerous territory. And watch for BOJ emergency intervention. If they announce emergency bond purchases or coordinate with the Fed, that means they're scared. Okay, so what do you actually do with this information? Let me give you 5 concrete steps. Number 1, understand that you're exposed. If you own US stocks, US bonds, or have a mortgage, you're connected to Japan whether you know it or not. This isn't paranoia, it's just how global capital flows work. Diversification across countries and asset classes matters more than most people think. Number 2, watch your long-duration assets. Long-term bonds are most vulnerable to yield spikes. If you're heavy in bond funds or target date funds with significant bond exposure, understand that risk. Consider shorter duration bonds if you're concerned about rising rates. Number 3, if you're buying a home, don't bank on falling rates. A lot of people are waiting for mortgage rates to drop. The Fed is cutting, right? Rates should fall. Maybe. But if Japan is selling treasuries, rates could stay elevated or even rise despite Fed cuts. If you find a good rate now, consider locking it in. Marry the house, date the rate. You can always refinance later if rates actually drop. Number 4, consider a gold allocation. Gold is up 14% so far in 2026, despite the recent setback. Central banks around the world are buying over 1,000 tons per year. They're hedging against exactly the kind of currency and debt instability we're talking about. You don't need to go all in, but a 5 to 10% allocation to gold has historically helped during currency crises and debt scares. Number 5, stay liquid. If August 2024 repeats, or worse, cash will be valuable. When there's forced selling, prices drop across the board. That's when opportunities appear. Don't be the person who has to sell at the bottom to meet obligations. Keep some dry powder. Have an emergency fund. Be the buyer when others are panicking. Want to know which chart has historically appeared before almost every major recession? Today, it's signaling a downturn that could be worse than 1929 or 2008. To understand what that means and why it matters, tap the video on your screen. I'll break it down.